In this video, we're going to continue talking about the corporation. And we'll talk about some basic tenets, if you will, or constructs of what the company is all about. What is their job? What is the task at hand for a corporation? In addition, we'll talk a little bit about the markets themselves, how the markets help us to finance corporations. So if you think about the ownership, obviously there is a management team. The board of directors are elected by shareholders, and essentially they have the ultimate decision-making authority. Now, this isn't about how many staples to buy or what office supply store to use. The board of directors is really a more big picture type of a group. Their basic goal is to evaluate and create the strategic plan of the company, to decide on some major purchases of assets, etc., and ultimately to decide how to distribute profits of the company. The CEO is really the person that delegates day-to-day decision making, right? They are the ones who are in charge of actually running the company. So if you kind of look at the organizational chart, you see that it is a pyramid kind of a shape. The CEO, the people who report to the CEO, really we have the chief operating officer and we have the chief financial officer. And there are some more CO things, right? So we have sometimes we might have a chief information officer, we could have a chief marketing officer, we could have a chief ethics officer. But in this case, we're concerned about the chief financial officer. That's the category of the company or the part of the company that financial management falls under. So what is the financial manager responsible for? Really just three things, and they're big things. Investment decisions. What assets does the company need? Do we need to buy more equipment? Do we need to expand operations? Do we need to replace equipment? Should we buy other companies? These are all investment decisions. The second thing we need to think about is the financing decisions. Where does the money come from to do the investment decision making for the company, right? How does the company run? Where does the money come from to ensure that that happens? And ultimately, how do we distribute funds once we have profits? The third aspect of managing the company from a financial manager's perspective is cash management. And it's a critical piece. I mean, without cash, you can't do anything. So this cash management aspect of the company requires some short-term, long-term planning for gathering funds to ultimately support the investment decisions of the company. So what is the goal of the firm? Most shareholders agree that they are better off if management makes decisions that maximize the value of their shares. So shareholders want managers to do things that will increase their personal wealth. And their personal wealth is identified as the stock price. So should we think more about maximizing profit or maximizing shareholder wealth? Maximizing profit is very important. I mean, we do have to make money, but what we're speaking of here, and this is really what the first bullet point refers to, is it talks about a variable for decision making. Profit is not the best benchmark. Well, why not? It's backward looking. It doesn't look to the future. It looks to what performance we have already completed. It's dependent on accounting principles. If we can change the variable by changing methodology of counting inventory, for instance, then it's not a stable, good variable for making decisions. And finally, it doesn't consider cash, right? It's an accounting number. It doesn't fully consider cash and when cash comes to the company. And although it's not apparent from this initial discussion, it also really doesn't look at risk. It is just a number that doesn't reflect when the number comes and or how risky or the chance that that number won't come. So maximizing shareholder wealth is what most modern shareholders or what most modern finance theorists claim as the proper benchmark for decision making. So we want to maximize stock price, not profits. And again, I want to come back just with a disclaimer. It's not that profits are bad. It's that profits are an unsuitable variable in determining whether to do financial things. Shareholders at the end obviously are residual claimants, and they have no incentive to give us money or to bear risk of getting money unless they have some form of return. So often shareholders' decisions often a corporation's decisions that increase value, ultimately that directly flows to society as a whole, right? As long as nobody else is made worse off by a corporation's decision, increasing its value is good for society. It only becomes a problem when it comes at the expense of others. Now, the others that we're talking about here are not competitors, right? We're talking about other stakeholders, right? The community, employees, customers, suppliers. We're not talking about the competitors of the company. One of the challenges that we have with the corporate business is that there is a separation between the owners of the company and the managers of the company. If you think about a sole proprietor is the owner. They are the manager. So they are one entity. So it's hard to think about an owner of a sole proprietorship or a manager of a sole proprietorship who would do something that on purpose that would hurt the owners, since they are the owners. So the concept, the idea we're talking about here is something called agency. Managers may act in their own interest rather than the interest of shareholders. They think of themselves first. So one of the potential solutions to this might be to tie management's compensation to firm performance. The challenge, and this is what researchers have been struggling with for a while, is how do you measure performance? Is it the same measure for every company, or is it different, right? Is it different by industry? So let's talk briefly then here about CEO performance. If a CEO is performing poorly, we can obviously express that dissatisfaction by selling our stock. Obviously, that selling pressure would drive the price down. Low stock price might entice corporate raiders to buy enough so that they could control the company, have a majority interest, and then replace current management. So the stock price is going to rise after they purchase this because, in quotes, we're going to fix the company and get rid of the old managers who weren't doing a good job. So the price of the stock can be an indicator of managers or owners' satisfaction with the company. So the stock market provides some liquidity for us, right? So if you can't sell your stock, you can't make a decision about management, you can't reflect your desires for changes. Without the stock market, you don't have any liquidity. So the definition of liquidity is the ability to easily sell an asset for close to the price at which you can currently buy it. So liquidity means you can sell it quickly and you can sell it at its current value. So with corporations, we could have public companies or private companies. Public companies obviously trade on an exchange. The stocks in public company are very liquid. It's very easy to sell them. Doesn't take much time or effort. Private companies, though, can be corporations, and this stock might be traded, but it is traded privately. So without an exchange, without the exchange mechanism, we have no verifiable value. I mean, that doesn't necessarily mean that they're small companies, right? But it does mean that there are difficulties with liquidity if you think about private companies, right? Technically, an individual cannot be a corporation, right? You need officers, S at the end, for you to be able to incorporate. There has to be more than one person. If we think about the stock market, there's several ways we can categorize it. One of the ways is into what's referred to as primary and secondary markets. The primary market is when a corporation issues stock for the very first time. It's never been owned by another person. So when a corporation issues stock when it's brand new, we call that an IPO, initial public offering. That's what's referred to as the primary market. The secondary market then are the trades between investors. It's every trade that happens after the first trade. The secondary market is where we are creating the pricing mechanism. The supply and demand falls into place once we start talking about investors trading. So what exchanges do we have? Primarily, there are two of them. There's the New York Stock Exchange. Recently, the New York Stock Exchange acquired the American Exchange. In this particular exchange, we have what are referred to as market makers or specialists, right? Each stock has only one market maker. There's only one person on an exchange floor that buys or sells a particular stock. The NASDAQ doesn't have a physical location. It's a computerized network. And we could have many market makers on a single stock because it is created by a computerized network. So what you can kind of think about this is brokerage firms all over the country are essentially kind of retail operations. They have inventory that is stock. So each one of those companies determines how much stock it has available. It buys inventory, and it also determines how much stock it sells. Now, the stock price is based on supply and demand, but there is two different prices, right? The bid price of a stock is the wholesale price. So a brokerage house, when they buy stock from an investor, or when an investor sells their stock, they sell it at what's referred to as the bid price. The ask price is the retail price. So this is the price that they sell it for, or said another way, that's the price that you as an investor buy for it. Now the difference between the bid-ask spread, just like in a retail operation, that is the transaction cost. It's a profit indicator. The range, right, the amount of the spread is dependent on many things. The volume of stock that's trading, the type of stock that's trading, the price of the stock that's trading, all of those things fall into this profit margin that the brokerage house acquires when it helps us with the liquidity of shares. So in, again, 2005, these exchanges accounted for about 75% of all the stocks that trade in the United States. Again, there's a lot more competition through alternative systems, right? Electronic exchanges. So the volume has gone down a little bit, right? Not tremendously, but the volume has changed a little. So if you kind of think about the exchanges, right? Where's all the money at, right? By market cap, you look, the New York Stock Exchange has the biggest cap. That's 22.1. All right. Again, I'm assuming that would be in trillions, right? The NASDAQ is next, and as you go around, we go to smaller and smaller exchanges. Now, if you look at volume, again, the NASDAQ has the greatest volume, and the New York Stock Exchange is next in line. And again, as we go around the circle, we find less and less volume that's transacted within those exchanges. So in a nutshell, what we're trying to say is that the United States exchanges are the dominant exchanges in the world. Again, if we look at shares, right, the New York Stock Exchange is the black line here, right? What does this tell us? That over the last several years, if you look at how many shares, there's been a decline. Now it's leveled off, but we also see that what other investment, other companies or other types of exchanges are growing in their the amount of shares that they ultimately trade. And again, if we look over here, we can see that there is, in general, if you look by market shares for the NASDAQ, depending on which one of these things are, you can find out that there are a variety of ways that we can exchange trades with respect to these different indexes. And again, really, we just want to identify the volume, right? How do things trade, right? Here's the New York Stock Exchange, here's the NASDAQ, and these other things represent other ways at which stocks can trade. In the end, if you think about buying and selling stocks, right, there's really just a couple of ways that you place an order, if you will. You can place what's referred to as a limit order. This is an order to buy or sell at a fixed price. So you call up and you say, I want to buy 100 shares of Apple at $700. If the price is $700, the transaction happens. If not, that order stays in what's called a limit order book, and it collects it. And when the price gets to $700, then that trade then occurs when the price comes to what the investor wanted. A market order is when you trade immediately. So you just call up and say, I want 100 shares of Apple. Whatever the price is, when the person gets to that specialist, that's the price that you pay. Now, there are some people referred to as being high-frequency traders. This is a little different than what you think about as being a day trader, right? A day trader sits in front of their computer and they make trades all day long, usually on very small value stocks because they don't have a lot of capital themselves. But a high-frequency trader basically makes trades with the use of a computer. So when the computer recognizes an algorithm that says, hey, it's time to buy, it makes the trade for these traders. So there's there's no personal touch, if you will, in the trades with these high frequency traders. One of the challenges with this is when the markets are declining, these things kick in and they initiate sales, which, if everything is selling, drives down the price even more, so we can get a cyclical downflow or a cyclical upflow as these algorithms hit. So there is some risk with volatility when we have these, what are referred to again as high frequency traders. Look forward to talking to you in the next video.